There's $36 trillion sitting in a vault that doesn't exist. No gold bars. No cash reserves. Just promises written on digital paper, owned by pension funds, foreign governments, and yes, your parents' retirement account. This is U.S. government debt. And somehow, it became the safest investment on Earth. Pause on that for a second. The biggest borrower in human history, a government that hasn't balanced its budget in over 2 decades, is where the world parks its money when it gets scared. How did we get here? Right now, the U.S. government pays about $1.6 billion in interest. Every single day. That's more than NASA's annual budget. Every week. And here's the part that should make you uncomfortable. Most Americans have no idea they're the ones lending this money. Your savings account? Backed by Treasuries. Your 401k? Loaded with them. That stable value fund your company auto-enrolled you in? Government bonds. We've turned the national debt into the foundation of retirement security. Which raises an obvious question. What happens when the foundation is built on borrowed time? Let's rewind to understand how this machine was built. After World War II, the U.S. had a problem. Massive war debt, a destroyed global economy, and a desperate need for dollars everywhere. So they made a deal with the world. We'll open our markets, protect shipping lanes, and guarantee stability. In exchange, you'll buy our debt and trust our currency. It worked almost too well. By the 1980s, buying U.S. Treasuries wasn't just safe, it was the definition of safe. The benchmark. The baseline. Every other investment on Earth got measured against it. Here's how the cycle works. The government spends more than it collects. Always has. So it issues bonds, essentially IOUs. Investors buy those bonds. The government gets cash now, promises to pay it back later with interest. Simple enough. But then something strange happened. The debt stopped being a problem and started being a product. Banks needed safe assets to meet regulations. Pension funds needed predictable returns. China needed somewhere to park $1 trillion in trade surplus. And the U.S. Treasury became the store that never runs out of inventory. They issue new debt. The world buys it. The cycle repeats. Everyone's happy. Until you look at the math. Here's where it gets weird. In 2001, U.S. national debt was $5.8 trillion. Today, over $36 trillion. That's a 6-fold increase in 2 decades. And during that same period, Treasury bonds remained the safe haven. Think about that logic. The debt exploded, and investors decided it was more trustworthy. Why? Because the alternative was worse. Europe had a debt crisis. Japan had stagnation. Emerging markets had currency collapses. China? Still a black box. So capital flooded into treasuries not because they were perfect, but because everything else was broken. The U.S. didn't just benefit from being safe. It benefited from being the least unsafe option in a dangerous world. But there's a cost to this. Every time the government borrows, it crowds out other uses for that money. Infrastructure, business investment, actual productive growth, it all competes with the safest, easiest bet, lending to Uncle Sam. And here's the kicker, the more debt there is, the more essential it becomes to the financial system. Treasuries aren't just investments anymore. They're collateral. They're liquidity. They're the grease that keeps the global financial machine running. Which means we can't stop issuing them, even if we wanted to. Let's talk about what safe actually means. A treasury bond is considered risk-free. But risk-free doesn't mean you can't lose money. It means the government will always pay you back. In dollars. Dollars it can print. So yes, you'll get your money. But there's no guarantee what that money will buy. From 2020 to 2023, inflation ran hot. If you held a 10-year treasury paying 1.5% interest while inflation hit 8%, you didn't preserve wealth. You lost purchasing power in slow motion. The safest asset in the world made you poorer. But people kept buying. Because in a crisis, no one cares about returns. They care about getting their money back. even if it's worth less. That's the quiet agreement holding this together. So where does this go? There are a few possible futures. 1. Nothing changes. The US keeps borrowing, the world keeps lending, and we all pretend the debt doesn't matter because it never seems to matter. Until it does. 2. Interest rates stay higher for longer. Suddenly that $1.6 billion a day in interest becomes $2 billion. Then $3 billion. The debt becomes expensive to service, and the government has to choose between paying bondholders or funding everything else. 3. Faith breaks. Not all at once, but slowly. A downgrade here. A failed auction there. Maybe another country's bond starts looking competitive. And the machine that runs on trust starts to stall. None of these are immediate. But they're all sitting in the background, waiting for the right trigger. Here's the uncomfortable truth no one wants to say out loud. The system works as long as everyone believes it works. Your retirement account is safe because everyone agrees government bonds are safe. The government can borrow because everyone agrees it will pay back. The dollar holds value because everyone agrees to accept it. Take away that agreement, the math gets ugly fast. We've built the most sophisticated financial system in history on a foundation of collective belief. And belief, as it turns out, is the one asset you can't diversify. So the next time someone tells you government debt doesn't matter, ask them this. If $36 trillion isn't a problem, what number would be? Because we're going to find out.